Goldman Sachs recently forecasting lower S&P 500 returns over the next decade compared to those of the last 10 years and really historically as well. But the firm is making the case that its outlook is not as bearish as it may seem. Yahoo Finance's Josh Schafer joining us now with more. And Josh, this call got a lot of attention because it did seem sort of pessimistic, but you got a little sort of nuance from them directly.
Yeah, so to give us the numbers here, right? So the 10-year annualized return over the last decade was 13%. That's slightly above the average annual you would get in the S&P 500 on any given year historically, which is 11. Goldman coming out and saying, due to high concentration in the market right now, that's the key factor here, they're projecting that over the next decade, the average annual return will be 3%. Now, I saw a lot of bearish sort of framing articles around this, and we talked to that team a fair amount, and I said, you know, they're pretty constructive on equities. I'm curious what they're actually saying here. So I talked to Ben Snider, who's on the team with David Costin over there, and he emphasized that overall they remain confident in the equity market, right? That's the broad takeaway here. They have a 12-month target of 6,300 on the S&P 500. That's higher than we are today.
Yeah.
But what he said is the key part that normally happens when we get to this high concentration level, and they're sort of those Mag 7 stocks, the top 10 stocks, all being the market, some shock eventually comes. And he said when you zoom out over a 10-year period, it's hard to have look into what that shock could be. And so he said, right now we don't see a shock. That's why we feel good about stocks over the next 12 months. History would tell us, though, zooming out over the next decade, you are rather likely to get some sort of shock that would unwind this, perhaps, I'll use the word bubble here, they didn't use it, but perhaps the percolating bubble we've been talking about. When you introduce some level of shock, that's when your bull market ends. You get maybe a year or two of a significant bear market. Then we average out that 10 and we get to 3%.
Is it, so it's concentration and it's potential shock, but is it also, and I haven't read the note yet, Josh, but is it also just mean reversion they're bringing up as well?
Yeah, so Josh, if you ran the numbers, right, and we did 13% for 10 years on average, and then you do 3% for 10 years on average, you come out to something closer in the 8% range over a 20-year period, which again, if we study the S&P 500 over a 20-year period, that's not that far off from average. So there is an aspect to that where they sort of say, okay, you kind of can't expect this forever. And I think what Ben told me is that's kind of been the takeaway as he's talked to investors talking about this note, saying 3% over the next decade. What are we talking about here? The takeaway being just don't expect the S&P 500 to rip the way it's ripped the last couple years in perpetuity here. You're going to get your job back.
Well, I mean, as you said, there was some pushback against it. One of them came from Nick Colas over at DataTrack, and he basically took a chart going all the way back to 1938 and looked at rolling 10-year periods and the compounded annual returns. There it is. The bottom dotted line there is 3%, the number that that Goldman's talking about. The top line is the average over that period, which is 10.6%. You said the average over the last 10 years is 13% or so. It's 10.6% over the longer term. And what Nick said was, he said things tend to get really bad before this happens. History, he says, shows that 3% returns or worse only come when something very, very bad has occurred. How bad? Well, we're talking about the Great Depression. We're talking about the financial crisis. We're talking about the oil shock in the 70s. So, yes, something like that could happen.
Something like that could always happen, though.
But but he doesn't seem to think that it is that way.
And he also made the case in that note, too, and this is sort of what the team over at JP Morgan Asset Management said at a roundtable I was at yesterday when they were asked about this, is if you really believe in this AI trade and you believe in this AI trade beyond the hyperscalers, then you're probably going to get good returns in the S&P 500 over the next decade because it's going to feed through to your 493 like we've talked about a lot. And if someone else becomes a key player in AI, this is specifically what Nicola said, wouldn't you think it's probably an American tech company?
Right.
If AI is going to be the trade and disruptive tech is the trade, the past several decades of empirical evidence tell you that's going to be a U.S. tech company. Where's a U.S. tech company going to be? The S&P 500. That's how you get your returns.
Makes sense.
We always spin it positive, Josh.
Totally.
No 3% returns. Come on.
You have to. Joshua, thank you. Appreciate it.